All right, people, for this class practice, we are learning how to calculate the profit for speculators in the derivatives market. So there are derivatives called futures, and also there are derivatives called options. So you can, based on your speculation, take different positions by utilizing those derivatives. All right. So right here, the market is saying that the futures price and the option strike prices are going to be $1 per euro at 3 months later. Okay, so the futures and the option strike prices will be exercised 3 months later, but this $1 per euro is available right now. So basically, if you enter into a contract for futures, then this is what the price is going to be at 3 months later. But the whole world is changing, and there are various factors that could affect the possible rate in the future. So here I developed a series of corporate rates for the euro prices ranging from $0.50 to $1.55. Okay, so whether you should take a long position or short position, or buy a call option or buy a put option, it really depends on your speculation. If you think the euro is going to be above $1 3 months later, which is above this futures price or option strike price, then you should take a long position. Okay, so if you take a long position, then definitely you will need to pay at $1, okay, 1.000. Okay, so, and you are a speculator in this game, so that means you are not buying 125,000 euros, which is the size of the contract, for fun. All right, you want to profit from a price discrepancy. You want to buy low and sell high. So you are not using 125,000 euros for a trip in Germany or Italy, or buy a Ferrari in Milan. All right. So you really are doing two trades. So here it's very important thing. So once you're a speculator, we are doing two trades. One is based on it's in the stock market. So whatever the price is. So this is the price 3 months later, so that's for immediate transaction. And another trade is using the derivatives. So if you long the futures, that means you, according to the contract, the futures contract, will need to buy the commodity in this term, in this exercise, euros. Okay, so two trades, don't forget. So let me just mark it here. All right, so if you long futures, so that means you're gonna honor the price of $1 per euro 3 months later. So you will need to pay $1 for sure, and at the same time, then you will need to buy 125,000 euros from the spot market at the prevailing spot rate. Okay, and then that's your loss at a per euro level, and of course it should be multiplied by the size, but to keep things simpler, I just like to calculate at a per euro level or per commodity. All right, so that means you are losing money if you will depreciate when you take a long position in the futures. You promise to buy futures at $1, but the actual worth of euro is $0.51, half of that, so you actually lose money. And you can just double click on this. As you can see, the higher the euro price is, then the more profit you can make. So right here, if it at 1.5, so that means you, as a speculator who signed a contract to buy euros, we call it long futures, then you will need to buy a euro at a fixed price depending on the futures contract, and then you will also sell the euro just about to the spot market at the prevailing price of 1.5, so you can make a $0.50 profit per euro. All right, and here for short futures, that's a different story. So if you think the euro is going to be below $0 3 months later, and you still can profit from a lower price, and we call it short. It's not like a short selling a stock, because when you're short selling stock, you have to borrow the shares from broker and sell up front right away. But for short futures, it's a much simpler format. You simply just sign a contract to sell the commodities at a futures rate. So right here, if you sell it, then you will make $1.00 based on the futures price. And again, you're a speculator. You don't have 125,000 euros in your pocket because you don't have a business in Italy, right? So you will need to buy the same amount of euro from the spot market at the prevailing spot price. So if the spot price is $0.51 per euro, and that's how much you will need to pay. And by doing so, you are making a profit. So you short futures at $1, and you simultaneously need to buy the same amount of euros from the spot market at this $0.49 per euro. Okay, so things are very straightforward. So you can see that it is really a zero-sum game. When there is a buyer, there is a seller, and the profit from the long position is exactly the opposite the profit from the short position, as you can observe. So that's how the futures market is. So some people believe the price is going to be higher than 1, some people believe the price is going to be lower than 1, and some people are going to take long position if they have a higher valuation, and some people are going to take a short position if they think it's going to have a lower valuation. Alright, now options. So options are different animals from the futures, and call and put are different animals within the options category. So options basically is like insurance plan, and when you buy an insurance, of course you pay the premium, and that's the same name for call options. So premium is the price of options. So the option has a strike price, same as the futures, just to put everything on the same page. So if you buy options, so that means you will need to pay the premium, okay, $0.01, you pay for that. And then, do you make money to trade as a speculator? Yes, if the price is in your favor. So a call option basically gives the option buyer the right to buy the commodity at the strike price of 1. So let's say if the price is 0.51, then you can buy at 1 and sell at 0.51. That's not the way it is, because if you do so, you're gonna have a loss. Or you can choose not to exercise the option and have a zero net benefit from the call option, but still you pay the premium. So you will need to add an if statement here. So the if statement basically is a comparison of the spot rate, the prevailing market rate 3 months later, versus the 1.000, the strike price today. So if the spot rate right here 0.51, but definitely it's lower, but I still need to establish this condition. If spot rate is higher, you will need to access the call option. So that means you will need to buy the stuff euros at 1.000 and then sell at the spot rate. Okay? Otherwise, if the spot rate is lower than the strike, then you choose not to exercise the call option, and then you get zero. So if that's the case, then your profit will be limited at $0.01 negative. Okay, so this is the case you do not exercise the call option. You can simply just double click here and generate all the profits for different possible rate. Okay, so as you can see, when the spot rate is lower than $1, okay, lower than $1, you choose not to exercise the call option, you choose not to buy at $1, and then you just pay the premium. And if the price is at $1 or higher, you will need to exercise the call option, and you will need to pay $1 per euro and sell at the prevailing spot rate. So this one basically means you buy at $1 and then you sell at $1.2, but why your profit is only 0.01? Because you pay the premium of negative 0.01. Okay? You can also do this. Alright? You can use the max function. Alright? So once you have possessed a call option, it's either you choose 0 or you choose the spot rate minus the $1 strike price. Okay, so this is either 0, either you make some money when the spot rate is higher than 1, or you don't make money at all. But for both conditions, you will need to pay the $1 premium no matter what. Okay, so use the max function, you will get the same result as if you use the if statement of the Excel. Okay, for example, right here, the spot rate is 1.48, and you will exercise the call option. You sell at 1.48, and you buy at 1 based on the strike price of call option. All right, and then you pay the premium of 1 cent, so you get a 47 cents profit. Okay, so for the rest of the class, I think I would be better off by using the max function instead of the if function, because I think max function is cooler and easier. Alright, to buy the put option. So put option gives the right to sell, and the call option gives the right to buy at the strike price. Alright, so if you buy the put option, that means you have the right to sell at $1. Alright, so if you sell at $1, then that means you can, in this case, you can sell at $1, and you will need to buy at 0.51. Alright, so that's the case. So you will use the if statement. Alright, so if the spot rate is less than $1, then that means you will need to exercise the put option by selling at the strike. When you sell at the strike, you earn $1.000, all right, and then you will need to simultaneously buy 125,000 euros from the spot market at a lower price. Okay, that's how you make profit, and that only conditional on the comparison of the spot rate against the strike price of $1. Otherwise, you do nothing, and then you will have zero payoffs. You don't exercise put option, you have zero payoffs. No matter what, you always have to pay the premium. And in this case, the put premium is 2 cents per euro. Okay, so right here, you actually is making some money. Okay, and you can also drag it down. So you will see, as long as the price is below $1, okay, the spot rate is below $1, you are making profit by having a put option, because you can sell at $1 at fixed rate and simultaneously buy at a lower rate from the spot market for immediate transactions. All right, so 2 trades will give you profit. However, if the spot rate is higher, if actual condition is saying that the euro appreciates, gets above $1, then as a put option buyer, you should not exercise the put option, and your loss will be limited to the negative premium. Okay, and right here, you can just use the max function. So again, it's a max of a 0 and the $1 strike minus the spot. So as a speculator, if you play with the put option, that means you will sell the strike and simultaneously buy at the spot. So when you sell, you receive, that's positive. When you buy, you pay, that's negative. And no matter what, you have to pay the premium. So you can see that's how you use this max function to get the profit based on different spot rate. Alright, the next thing you should do is to create a scatter chart. So I want you to first click on a blank cell and then insert, and I want you to do this second row, second column, the scatter chart with the straight lines. Alright, and then you move it a little bit and select data, add. It's called a long futures. The X values would be all this possible spot rate, and the Y values would be the profit for long in the futures depending on the spot rates. Okay, and now let's add another series. This series has a name called a buy call options. The X value again will be the possible spot rate, and the Y values would be the profit for buying the call options. And then hit OK. So you can put your chart somewhere and make sure you show this layout. So this is the name called profit curves, and you have profit as the vertical axis, and then spot rate in the future, or the prices in the future. Okay, and for the legend, you can just place them down the bottom. Alright, and you can just enlarge it to make it a little bit more presentable. Okay, so if you take a long position of the futures, you can see indicated by the blue line, you make money, the profit is positive when the price appreciates in the future, and vice versa. But if you do a call option, you are again you can take advantage of a price appreciation, but your loss is limited downward. Okay, because you have the option not to exercise the call option. All right, and your loss is minimized at the negative premium. But for futures, you are signing an agreement that you have to buy at whatever at $1 per share, no matter what the price is. Okay, and you will need to do another chart here, and another chart. I will do the short futures and buy put option. So right here, insert. Ooh, that's what happens if you don't click on the black cell. Okay. Okay, so the Y value, select data, add. The name is short futures, and X values again would be the spot rates, and the Y values would be the profit for short futures. Control Shift down. All right, and then add another one, and this one's name is by put option. X values would be all this spot rate, and the Y values would be all this profit. Okay, hit OK, and then you visit this chart, and you put a layout. The layout, oops, click this, put a layout, and this layout is profit curve. And you can format legend by placing them down the bottom. Okay, the vertical axis is profit. The horizontal axis is spot rate in the future. You know, the spot rate in the future is different than the future's price. You know that, right? Okay, future price is something you sign up on, which is a fixed, and spot rate can be anywhere in the future. So if you make comparison, you can see that if you short the futures, you can make a profit when the price decline, and you can also make a profit by buying put option when the price decline. But if you buy a put option, then your loss is limited to the negative premium, and if you short futures, then there's no limit for your losses because you are obligated to sell at $1 no matter what if you sign a short futures contract. And when the price increase, so you would suffer a lot losses. Okay. The next thing is to get a profit chart for the call buyers, call writers, put buyers, and put writers. Okay, so for call buyers, we actually have done that. Again, I'm going to use the max function. It's either 0 or you use the call strike. You're gonna buy that, so you will pay for that, and then you can sell at the strike rate. You can sell at the spot rate. So you buy at the strike and you sell at the spot. And of course, you always have to pay the call premium as a call option buyer. And then you want to make sure the premium is locked and the strike price is locked. Okay, so if the spot rate is below the call strike, then that's not good for a call buyer because he is not making any extra profit and he still have to pay the premium. If you drag it all the way down, as you can see, if the spot rate goes up, then between 0 and spot minus strike or negative strike plus spot, then that's a profit. If you exercise it, you can buy at strike and then sell at a spot. And for a call option writer, they are just completely opposite. So when the call option is exercised at a strike price 1.12, the call option buyer will buy it at this price, and who is a counterparty to fulfill this trade, to honor this trade? It's going to be the call option writer. Alright, you don't have to dig into whether they buy or sell at the spot, buy or sell at the strike. You simply just need to remember this. The call option writer's profit is negative of call option buyer's profit, as this is a zero-sum game. Okay, so you can see it's completely the opposite. So whatever the call buyers make is the loss of a call option writers. Alright, and the call option writer, by selling this call option, they collect the premium from the call buyers. And when the call option buyer accesses the call option, makes some money, then the call option writer have to do the counterparts and trading and then suffer a loss. And for a put option buyer, so again, it's a max of a 0. Not access option and between not exercising the option and accessing the option. If they access the option, they're gonna sell at a spot, and then they're gonna sell at the strike for put option, and then buy at the spot. So when you sell at the put, make sure it is locked. All right, and for a put option buyer, they always have to pay the premium. It's always in their calculation. Okay, so in this case, when the price declines below the put strike, then the put option buyer is actually making some money. Okay, and for put option writer, for the same idea, it's a zero-sum game. You just put a negative of the put option buyer's profit for the profit of the writer. Okay, so when the buyer is making profit, the writer is suffering a loss. And when the buyer is not exercising the put option, and the buyer's profit is negative premium, and for the put writer who sell the option to the buyer, they collect the premium from the buyer. Okay, so the next thing for you is to generate the chart. Okay, so click this blank cell and do a chart. And I want you to compare the buyers and the sellers' profit. Okay, so right here, add is called a call buyer. X values would be all this possible spot rate, and the Y value will be right here. Okay, and then you add another one. It is for the call writer. The X value would be all this spot rates, and the Y value will be all this profit. Okay, so this chart is showing you that for option buyers, so you can see the loss is limited and the profit has unlimited potential because the price can increase infinite. But for the call option writer who write the option, create the option, and sell to the buyer, the profit is limited, but the potential loss is unlimited. So you can edit a little bit. Click on this axis, the minimum. I just want to make it as 0.08. All right, the maximum I want to make it a 0.14. That's fine. All right. And then for the quick layout, I just want to show this profit curves. So for the Y value, it is a profit. The X value is the spot rate in the future. We don't know where that is. This line gives you all the possibilities. Right here, you have the profit curves, plural. Okay. And then you can do another chart. So click on the blank cell and you insert same type. Okay, right click, select data, add, put buyer. X value would be all this spot rate. The Y value would be all this profits. Okay, add, put writer, X value, again all the spot rate, and Y value would be all this profits. Okay, and then you can just define the range a little bit, make it start from 0.8. All right, and then for the quick layout, you can put a profit curves, and the y-axis name is a profit, x-axis the name is spot rate in the future. Okay, so you can see that for put option buyer, they make a profit when the price decline, when the price is going down to the left, and for the put option writers, the losses is higher when the price is going down. So in other words, if you think the price is going up, you can make a profit either as a put option writer or as a call option buyer. If the price is going to the left or it's going down, you can make profit by being a put option buyer, that's your profit, or a call option writer. So either way, you can utilize these options to make money depending on your expectation of future prices.